Traders spend much of their time looking at charts and analyzing using technical and fundamental analysis or the combination of both. While these indeed are very good things to spend time on, not all traders take the time to focus on the risk management and more specific positions sides. I see a lot of the new and the old traders or the investors which trades only to have their accounts blow up by the taking random positions with no plan whatsoever. Proper positions sizing is the key to the element in the risk management and can determine whatever you live to trade another day or not. Basically, your position size is the number of the shares you take on trade. It can keep you from the risking too much on the trade and blowing up your account. Without knowing how to size your positions properly, you may end up taking trades that are far too large for your account. In such cases, you become highly vulnerable when the market moves even just a few positions against you. Your position size or the trader size is more important than your entry and exit when trading or investing. So you can have the best strategy in the world, but if your trade size is too big or too small, you will easier take too much or too little risks. So how do you prevent yourself from the risking too much? How do you how to know the right quality to buy or sell when you're invitates positions? Let's say you have $10,000 in your account and that's and their stock's value at the 100 you like and want to buy. Do you buy 100 shares or 10 shares or some other numbers? This is the questions you must answer how to determine your position size. If you decided to spend your entire account balance to buying 100 shares, then you will have the 100% commitment in the stocks, and that's not indicated also in taking the positions that represented a large profit portion of your total profit. There is a lot of the opportunity cost involved. You would have to pass up other traders that you may have linked to easier positions. Sizing the critical issue that trends needs to know beforehand and not do the fly. That's important as picking the right stocks or currency to invest. Never traders or the investors like the calculations how much money could make to the upside, how much money they could potentially make, and focusing less on the how much money they could potentially lose. There's several approaches to position sizing, and I will run down some of the more popular ones. The first one and the most common one, to fixed percentage per the trade. Position sizing can be a balance on the size of the overall profit. This means the percentage of the what overall capital will be predetermined per trade and will not be expected. That could be 1% or even 5%. This fixed percentage is an easy way for you to know how much you are buying when you buy. To use the simple example of the fixed percentage positions sizing, the again as $10,000 account size and 1,100 stocks. If you take the SMIP 1% positions balance and on your account size that comes down to the single shares, you may be thinking you are the better of the what than the person with the $100 account buying one shares. The difference is that the $100 account holder has 100 positions size, while the 10,000 accounts holder is putting just 1% at the risks. Which position size allows the traders to sleep better at night? Of course, the second one. Positions setting helps to control risks. 1% hard limit on each trade allows you to tolerate many losses in search of profits. projections. Your capital is your primary jobs. Your second jobs is allowed room in the your profitable to find other trading opportunities. The fixed percentage almost is the easy approach to accomplish this. The second risk management approach involves the fixed dollars amount per trade. This approach also uses the fixed amount, but this time it's fixed dollars amount per the trade rather than the percentage of the account profit. This involves choosing a number again, using the same $10,000 profile as the example. So you decided you won't spend any more than you say $200 on any one trade. For traders with a small account size, this can be an attractive approach because it limits how much you can lose. However, it is also limits what stocks you can buy. You will have to rule out some securities basements salary to their price. Of course, this is not necessarily a bad thing. The third approach, volatility-based position sizing, a more complex approach, but one that allows for more flexibility is position sizing. Sizing balance positions. A more complex approach, but one it allows for more flexibility, is position sizing based on the volatility of the security you plan or purchase. It's more dynamic because it doesn't treat each stocks the same. This approach allows you to drill down to the experience, finder control over your profile. For example, growth stocks will invariably be more volatile, and that volatility will be reflected into your profile. To reduce the overall risks of your portfolio, you would buy less or the higher volatility stocks that you would buy lower volatility stocks. You can measure volatility with something as simple as the standard deviations or over given periods, say 15 to the 10 trading days. Then, depending on the deviations, you adjust the amount of the shares that you would buy lower volatility stocks. You can measure volatility with something as simple as the standard deviation over the given period, say 15 to the 10 trading days. Then, depending on what deviations you adjust to the amount of the shares you buy when you evaluate it as positions. This allows lower volatility stocks to have more weight in your portfolio than the high volatility ones. Positions sizing based on the ideology lowers overall volatility within the portfolio. This strategy is frequently used to the larger portfolios, and I use personally in my own portfolio. Even longer terms trades and investors face positions sizing questions. For them, when the price of the security they are holding goes down, it represents more value addition to their positions, and case is reflected to us. Averaging down the long-term trades can decide it in the average down using the similar position sizing approach by risking either the flexed dollar amount of or percentage amount when the stocks trades down. You can use standard deviations here as well to help to figure out that amount. Averaging downs need to be used with the caution, because if your analysis is wrong at some point you will be in the positions which is no longer worth holding. You don't want to average down to the zero by buying all the way down. Some additional common sense risk permanence seems worth mentioned and may be incorporated into your trade plan. For example, to be safe, you must be able to accept losing on any given trade, and to be able to survive the token losing on the 10 consecutive trades, and those 10 consecutive losses should not expect a total 25% of the trade down. This means that no more than the 2% of the portfolio should be put in the risk or any particular trade. Once you figure out how much you are comfortable losing, and stop loss level for the each trade should be determined and placed in the market. The scenario traded will generally known where you put their stop loss orders after they haven't optimized their trading plan. And chart analysis is often performed when they're setting stop loss levels. Two rules of the tumble should be followed. So when you use stops to manage risk on your positions, first, never adjust the stop loss to arrive to the deserved position size, but instead of the adjust the size of the positions to meet your risk level to desired stop loss order placements. Based on your analysis, second, trade using the same risk permanence on every trade regardless of the distance on the top of the loss. Avoid putting your money at risk to use wider stops, and avoid risking any less money on the stop closer to the trading level. Adjust your positions to meet your predetermined risk levels. By now, I hope you realize that the correct positions citizens is crucial. You should always consider how much you buy when you buy, and also know how much you came up that number regardless of your account size. Take the time to come up with the considered approach that matches your trading styles and that sticks it. You can incorporate flexibility. For example, if you are willing to take more risks with your portfolio, you can deal up with the percentage you use. Sound money management techniques can help make the average trades become better and a good trade become greater. For example, a trade that you only write half of the time but gets out of losing trades before the loss becomes significant, and knows to the right winners to the substantial profit would be way ahead of the most others who trade with no clear plan of the actions whatsoever. And you have to find the right balance, because if you risk too little and your account won't grow, and if you risk too much and your account can be destroyed in a few bad trades. If you found value, learn something, you leave us a like, and I like to show your support, and make sure you subscribe to hit the bell icon to stay notified when we upload next videos. Until next time.